Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the state of the rally on this decision day for the Fed. The investment committee debating where your money might go from here no matter what happens in a couple of hours. Joining me for the hour, Stephanie Link, Joe Terranova, Carrie Firestone. Let's check the markets. Careful how you look at it today, too. You do have new 52-week highs today for the S&P 500 and the NASDAQ. That Dow decline right there is basically all due to United Health. So take that with a grain of salt, and we're going to talk more about that later. However, Stephanie Link, does anything about this rally hang in the balance today with this Fed decision? We think we know what the decision is going to be. We're not necessarily sure we know what comes after that, though.
No, I mean, look, I think we're all expecting a hawkish pause, right? And I think the inflation numbers from yesterday and today really give me confidence, give all of us confidence that they are going to pause. How hawkish are they going to be? That's
the
biggest
hawkish
question.
Pause is they pause now, but then they signal they may go in July.
They may go in July or hint. I think no matter what, they're going to talk about being data dependent. So we're all going to continue to be data dependent. So we're not going to really have answers about July.
But if they leave us believing that it was a hawkish pause, does that upset the rally?
No, I don't think so, because I think that's what we're pricing in right now. So if they're even a little bit more dovish, I think the market can go to the upside. And I think what's interesting, Scott, we've been talking about the broadening of the market, right, for the last couple of weeks. It's not healthy to have 10 companies, 10 stocks account for 90% of the returns year to date. So the broadening is very positive. Why are we seeing a broadening? It's a couple of things. We got through the debt ceiling. We got through the bank crisis. We now are getting through inflation. Inflation's not perfect. It's still high. The Fed's still going to be focusing on that, but it's coming down quite substantially, and that is good news. And so as we kind of get through some of these things and we check mark these things, I think that's the reason why people are willing to look outside. And it's not just cyclicals. It's not technology versus cyclicals. It's like technology can cooperate and continue to do well, but it could be also other parts of growth that can participate, right? Could also be small caps. It could be international, which is what we're seeing. So I think that's more healthy, and I hope it will continue.
Joe?
So I think the most challenged position to have, in particular after today's Fed meeting, is those that bought money market funds. I think if you are sitting in a money market fund after today, you have a real problem, because how are you now going to time your way back into the market? The Federal Reserve, for the better part of the last year, was behind. They were basically jogging when the market was running, the bond market was running. So therefore, they had to sprint. And it's reflected in the real Fed funds rate. Look at the real Fed funds rate, which is the Fed funds rate minus the inflation rate. This is now the second consecutive month that's in positive territory. 1 year ago, that was minus 600 basis points. So the Federal Reserve, they didn't have to go from jog to a run. They had to go from a jog to a sprint. So even if they were to raise 25 basis points at some point in the future, I don't see that as problematic for the recovery that we have had.
Yeah, why do you think people are going to pull their money out of money market funds if we get a hawkish pause? Why would they do that? I don't see that at all.
Because those, first of all, if you're sitting in a money market fund, relative to equities, you're massively underperforming. Now on the other side of that is fixed income. If we've seen the high for yields, if you have peak yields, peak monetary policy, what'll happen is credit conditions will improve, the soft landings coming back into play, high yield and investment grade, you're ultimately going to get a better return, and those money market yields are going to begin to deteriorate as we move forward.
Yeah, but not if, Carrie, the Fed makes you think that they're going to keep rates where they are for a long time. They may be done hiking. Yeah. That doesn't mean they're cutting. They may be sitting.
Right, exactly. And that would, we expect that's what's going to happen. And I don't think the Fed is going to be particularly hawkish. And I believe that the rally does depend somewhat on the tone of hawkishness versus dovishness that we hear from the Fed. Because if we notice what's happened over the last month, we've seen some broadening of the market. Look at small caps. There's a chart we put together. It shows that small caps are up more than the S&P. Now, I understand that the mega cap, 7 are up tremendously, but there's been a move, it's 8% roughly versus 5-ish for the S&P over the last month. And that's because investors believe that the Fed's done for now. I mean, done, I think, for the rest of the year.
Well, look, because once you stop, I don't really care what they say. You can make the argument that once you stop, it's awfully hard to restart.
Sure
Yeah,
is.
yeah, exactly. And I think that what the market has been building up to is to let other parts of the S&P and the broader market catch up with these mega caps and start to see some participation. If it's 2% for the overall market, and it's three sectors: consumer discretionary, communication services, and technology that are up 35% on average this year, and the rest of the market is not.
I think they,
to that
I think
point,
they
I mean,
can start and stop, Scott. I do. I don't think.
I mean, it
it's
just
gonna
makes
be
it a little
easy.
harder. Sort of once you stop, you would have done 10,
Right.
okay, to this point. And if you say you're now going to not do one, and you've had inflation data pretty good, it may be harder to just restart.
Right. My
again.
point being, like, they could stop and then restart if the data gets bad, right? If the inflation data starts to turn and go higher.
Yeah,
I
but
think that gives them cover. I mean, this is a challenging time for the Fed. They were behind the curve on both sides. So I don't know if they want to get it wrong 3 times.
On the notion of, what parts of the market can do well, Kerry's chart was pretty telling, Joe. And Chris Harvey over at Wells Fargo says, we believe the rotation into mid and small caps that started earlier this month has legs. So this broadening of the rally, which has made the rally feel better and look more healthy to people, may have some legs, according to him, and maybe according to Kerry. Do you agree?
I do agree with that, and I think a lot of the reasoning goes back to my initial comments, where credit conditions are ultimately going to improve. The expectation that we would see significant defaults in credit, I don't think that's going to be the ultimate reality. And I think when you're thinking about this Fed policy and the effect on the select equity size classes, small, mid, and large, the real challenge for small and mid is if we were to go back to the days of the 50 and 75 basis points, and we're not going back to that.
That'd be tough.
And we're not going back to that. And I think you realize that the Fed has finally caught up to the bond market, caught up to inflation, and that's a good thing for small, a good thing for mid, because last year was all about 50 and let's go to 75 4 consecutive times. That was the challenge of small and mid.
It's like you could make the argument, though, that the bond market's the one that caught up to the Fed, not the Fed catching up to the bond market. The bond market was the one that was out of alignment with the Fed, more than the Fed out of alignment with the bond market. So, maybe they've come to, a bit of a closer view there.
I think the regional banking stress contributed to that.
So the other idea is whether you think the bulls are really in control of the market after coming back 20% from the bottom, this alleged new bull market. Wolf's Rob Ginsburg, man, have I been wrong? He said, tough month to be a bear. And they've been bearish. I mean, Wolf has been almost, I think, gosh, I don't know, for the last year, it feels like, and I might be wrong, and if I apologize for that, but they've been bearish for a while. And every snippet of every note virtually that we've put in our show from them has been negative. They say we're firmly overbought. When you have strong momentum tailwind, though, these conditions can persist and become even more extreme. So, even the bears are saying, I don't know, this might have legs.
You've been wrong for a year, and earnings have held up. We've talked about that. The economy has held up. It's stronger than expected. The Atlanta Fed GDP now at 2.2%. No one was thinking of that. And I actually think you probably could surprise to the upside, right? Inflation is coming down. That's good for companies and corporate profits as well. So I think the momentum in earnings can get better.
I thought higher inflation was better for corporate earnings.
Well, I think I would say higher inflation is bad for input costs. That's what I'm talking about. Input costs come down, and you still have some pricing power. Maybe not as much as when inflation was really booming, but I do think that you'll see better margins, or margins at least that will hold up. And so if you have an economy that holds up, and that helps the top line, and then you have this input cost coming down. You also have a dollar that's not out of control and a big headwind. It's not the tailwind it was a couple of months ago. You add it all up, and I think, you can make a case to continue to be bullish. And then as we're talking about the broadening, that makes me feel better. I don't know about you guys, but
absolutely.
I don't think when you have 10 stocks that account for 90% of the returns,
up 73% this year.
That's troublesome, right? And
definitely.
so many other stocks are either flat or down, right? So I think that there's a lot of opportunity.
About that opportunity, do we think tech has run its course for a bit, or no? Market action would suggest the answer to that is no.
Yeah, it's hard to say. I mean, what we're experiencing.
How's it hard to say?
It looks like tech can continue to go higher. It doesn't have to go up at the rate that it's been advancing. I mean, it's been ridiculous. No, don't take away ridiculous. It's been great, but it's
you
been
own a lot
extreme.
of them.
Yeah, but it's been extreme, and so one would expect that if the market broadens, the money's going to come from somewhere. So some of it, I think, will come from some of the mega caps, even as other people
really
buy.
Think so?
Oh, they can
Why
continue
wouldn't it
to
come
go
from?
up.
Maybe it would come from cash. Maybe it would come from Joe's money markets.
Yeah,
maybe it would come from bonds. Maybe it would come from gold. I don't know.
But the rate of growth, I don't think is going to be as high. The market can go up just fine with more participation, which, I'm hoping that's what happens.
Tesla up 13 days in a row.
Yeah.
Well,
13. NVIDIA closed yesterday above $1 trillion in market cap. Wedbush, as Dan Ives said, can tech go higher? Yes. As the AI revolution takes hold and the Fed waves the white flag, says this is 95, not 99.
Yeah,
Don't be confused.
I think you need to think about technology in terms of where we're going to be at the end of the year, not so much where we're going to be in the next 90 days, because understand, within the next 90 days, when you study the historical statistics, this has the highest probability to be a flat or negative quarter, July through September. So we sit here on June 14th. If you were to tell me the market's in the same place on September 14th, I'll raise my hand and I'll say, I'll absolutely take that, because we never really got a significant correction. So you think about where we're going to be 6 months from now. Without question, all the evidence is suggesting leadership is back. It is in technology, and that is something that for the very first time since the pandemic is going to remain in place through the end of the year. The problem for most money managers is that they are turning a battleship, and battleships turn very, very slowly, and they are not able to turn fast enough into the technology trade. And I think that's why a lot of people are frustrated right now.
So there's no indication that Wall Street thinks that these stocks are not going to continue to go up. I mean, Meta, Piper Sandler today raises the price target to 310. They reiterated outperform. Wolf raises Meta's price target carry to 330. I feel like we have an opportunity for a good conversation here. It's maybe your largest overweight position, or certainly one of them, whereas Steph's been trimming that stock recently. So it's a tale of two perspectives on the same stock that's done real well. What's your take first?
So I understand why anyone trims a stock that's had the kind of move that Meta has had. So it's not as if we're not going to trim it at some point. The peak of the stock was about 380. The company is in better shape, in our opinion, than it was when it was at its peak, because it did not recognize at the time some of the factors that are playing in the market. It didn't understand that the metaverse was not where all their attention ought to be. They didn't understand that they had too many employees, that they had too many people in different directions that were not efficient. So cost cutting has been a factor. The focus on the businesses that are good businesses and how to monetize Instagram and WhatsApp are more important to Meta and the management of the company. And it's not an expensive stock. It still trades at a market multiple. We think it has room. But if it were to get back to its all-time high, then I would think for sure we would consider.
I mean, as the stock went up, it became 8% of my portfolio. And so that's a lot, right? So I'm just trying to control risk a little bit. But at the same time, you have to admit, Carrie, that a year ago, this stock was trading at 11 times forward estimates.
Yes.
Okay, granted, they were depressed earnings. I got it.
Yeah, no,
and it was a cost-cutting story, not a revenue growth story, which it is now. But it's now trading at 21 times. It was trading at 7 times EBITDA. It's now trading at 18 times EBITDA. So to me, that's a big re-rating. And I think a lot of good news, not all of the good news, because I still own a big chunk of it, but I think a lot of the good news is actually in the stock. I mean, no one was talking about the revenue side of the equation all year long, only until about a month and a half ago. And then all of a sudden, like, the light turned on, and all of these things started to click for Meta, right? It was Reels and it's click for message or click to message.
Well,
and 8% is a lot. 8% is also a lot. We don't have 8%.
The danger in thinking that all of the, in your words, good news is in the stock, conventional wisdom would tell you yes, but AI is the most unconventional of transformational things that we're talking about now.
Right.
So how do you know how to value something like that as to what it really means, to whether you know it's in the stock or not? Because what we thought was in NVIDIA was obviously not. based on the guidance that they gave.
Well, I just think up 120% on the year to date is a lot. So there's a lot of good news in there.
The numbers don't tell the whole story all the time.
Well, possibly. And I know the ad revenues, digital ads are actually on the rise. They were up 4% last quarter, year over year. I mean, prior to that, the prior 3 or 4 quarters, it was negative and there was no visibility in sight. So I'll give you that maybe not all of it is in the stock, but I think a lot of it is in the stock. But I still own a 5% position.
Yeah,
so it's not like
I get the nervousness of saying, well, the stock's up 100 and some odd percent. I'd be crazy not to take some off the table. But I'm just suggesting or throwing out the idea of the danger in that is we just don't know what the capabilities of AI are going to be in terms of earnings power for most of these companies. We just don't know. We're relying on what they're telling us. In some cases, nobody knows until you hear from the company. The analysts can't model it, obviously, or they would have known what NVIDIA was going to drop.
No, and then I mentioned digital ad. I mean, AI is really certainly helping them in getting that back to growth. So it's certainly helping. Where does it get to? Does it get back to double digits? It's entirely possible, especially against easy comparisons. But again, I think it's prudent to take take profits. Nothing's really wrong with ever taking profits. And so I still participate. I'm still a believer, but no one was a believer a year ago. I was getting hit every single day. You and I were. We were getting hit every single day because we owned it. So now I'm willing to just sell a little.
Okay, that's cool. Let's bring in our headliner, Professor Jeremy Siegel of the Wharton School, Professor Emeritus at the Wharton School, Senior Economist at Wisdom Tree, of course. Professor, welcome back. We're talking about who's a believer and who's not a believer. Are you a believer in this rally? Or I see a headline that you said somewhere that the stock rally is going to end soon. Is that what you think?
Well, NVIDIA, which is a great company, I think is selling for 123 times earnings. NASDAQ is selling for 30.
Well, it's like 50 times. It's selling for like 50 times forward earnings.
The S&P, okay, a little less. S&P is 20, which is, by the way, where I think S&P should be at 20. And the small and mid caps are at 14 and 15. You know, if you're a long-term investor, you know, you got to take that into account. If you're a short-term investor, you got to take momentum into account. And, you know, being one of the older people, I think, that you interview, but I think most of the people on your panel, we've lived through the 90s and the internet, and it went much further in terms of dispersion of growth and value back then than it has now at this point. So, yeah, the dispersion is high, but can it get higher? Absolutely. Is the momentum there? Yeah, there are probably more momentum players now than there have been, you know, 20 years ago, although there have always been momentum players. So, you know, in terms of, you know, whether you're a long-term investor and, you know, the small and mid-cap, they begin to stir a little bit. Momentum is still with those high tech. And if there's any signs of recession, you know, last week, people asked me what was the most important thing I was looking at. And I said, you know, I think the CPI and PPI are going to come in nice. The Fed is going to pause very hawkishly, by the way. They may actually be, I think the dot plot's going to be startling to people because I think a number of them are going to raise their rate projections. But actually, I'm looking at tomorrow's jobless claims because that was a little bit of a shocker last Thursday, and that's the first indicator you might see of softness. Now, again, it's a volatile short-run indicator. But my feeling is what's going to be driving the Fed for the remainder of the year is going to be the real side and the labor market more than the inflation. Inflation is going to calm down. The inflation is basically over. Now, I think I have a chart. I think you guys have helped me prepare that. I don't know if you can show you. Yeah, that the blue. So that is core service inflation over the last year. The blue is shelter, which is the biggest single component. Now, that's because the Fed uses extremely lagged, and I have to say faulty data on housing. We know home prices are down. There was an article in Wall Street Journal today about year over year, housing rates are 0 or negative, but because of the lagged way, that blue line is dominating. If you take the blue line out of that, you get core service inflation at 2% or less, which is exactly the Fed's goal. So, I mean, in essence, they have slew the inflation. It is basically gone. There's the residual. There's the data problem. They should stop completely. I think they should have stopped before.
Right.
And I'm worried about whether they stop soon enough, but we will see on that issue.
I'm still confused, though, as to whether you think, Professor, that this rally is about to run out of gas or not.
It doesn't look like it's going to run out of gas. Even with, there may be a little sell-off today at 2 o'clock when we see the dot plot. People say, "Oh my God, the Fed is going to get higher," and he's going to take a very hawkish. He's going to say we're going to pause, but he's going to take a hawkish position. And we know the last 6 sessions we've sold off 200 or 300 points on the last hour of trading on the day that he's come in. So if you want to look very short run, I wouldn't be surprised to see the same thing happening today. Is it enough to slightly derail the tech move? Usually one strike is not enough. It usually resurges again and continues on. There needs to be more of them, and we haven't had more of them yet. So I can see the tech moving ahead and the spread widening in the short run.
The further tech runs, does it make you more nervous or not?
Yeah, it means it's more vulnerable to negative news in the future. And if some tech company that's doing so well, gets a report, oh my God, the competition is tough. Oh, they're not paying for the AI chips as I had hoped to. Are they finding the savings? What's happening to consumer? Those cumulatives cause the correction. It's just that you never know when that might come. Momentum is there for the momentum players right now.
You still think we're going to have a recession?
I think that there's a 50% probability that we're going to have one. I think it's going to be mild. And I don't think it's going to cause profits to go down more than maybe 5 or 10%. And by the way, I think small and mid cap are positioned for, when you're selling in value stock, when you're selling 14, 15 times earnings, you're saying, you know what, I'm worried about a slowness in the economy. Now, the big tech stocks are not worried about the slowness in the economy because they think they're priced for the mega trends and they're looking over that. But the small and mid cap people are saying, listen, I'm not going to touch those until we can get through that. It gives you bargains. They may go a little bit lower if we get that recession, but not much more than 5%. And then I still think 2024 looks good.
You think the tech is fairly valued here or overvalued?
Right now, I would say it is slightly overvalued from a long-term perspective. If you take a look at how tech is valued relative to the other stocks, that doesn't mean, again, that it won't continue to rise in the short run. And let's be honest. We compare with the past, but we are seeing changes in the economy, and you have to admit it. With AI and others, that may be different than the past, enough to keep this story going for an awfully long time. But let me remind everyone, and we all know that, we live in a competitive world. If you really want to be a super growth stock for a long time, you got to build a moat around you that no one can compete. Just because a particular good is growing faster and the demand is there, if you can't charge a premium for it, you're not going to get a premium valuation. So the question is there a moat? That's the famous Warren Buffett words, a moat around it, which is going to make it harder for anybody to attack NVIDIA's chips or any of the other stocks that are moving so rapidly today.
If you think there's a 50-50 chance at a recession still, would you urge people to buy, deep cyclical stocks, industrials, things like that? You like those here, even as you think
because they're selling at 14, 15 times earnings. So if they go down to 12, 13, 14, another 5 or 6%, I think that is foolish to try to time that. I think once you get out of the dip that we might have, because I think the Fed has gone too far, I think you have a really nice valuation and appreciation story later. And I'd rather people be in then than try to time any sort of recession right now. That's a fool's errand. I think almost everyone on the panel will agree that it's almost impossible to do. Get into the cheaper stocks now, and I think you're going to be rewarded in the future.
That's a good place to leave it. Good last word. Professor, always appreciate your time. Thank you so much. That's Professor Jeremy Siegel down at the Wharton School. He agrees. Professor Link and Professor Siegel sound pretty similar.
Yeah, absolutely. I mean, I totally agree. If we go into a recession, the cyclicals are going to get hurt, for sure. But I do think they are already so incredibly cheap, so incredibly under-owned, and their balance sheets are much, much better versus the last cycle. So I thought his comments were interesting about 2024 and how excited he is about it. That implies he thinks earnings are going to really snap back.
Well, I mean, they're priced to snap back. They better.
The parts of the market that are pricing it, and there are parts that aren't. We just talked about the cyclicals aren't pricing it, but the technology stocks certainly are.
Yeah.
So I
mean, earnings projections in general are, projected to rebound pretty substantially.
About 11%, for sure. So, but that's good. That's good news.
Yeah.
That's good news for stocks.
Of course. All right. Well, still ahead. Our chart of the day. It's United Health. It is the worst performing stock in the Dow today, accounting for nearly every bit of that triple-digit loss for the Dow. That's the worst day in roughly 3 years for UNH. 2 of our committee members own it. We'll get their strategy on it next.